Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Pierre Debbas. He is a co-founder and managing partner at Romer Debbas, a boutique real estate law firm located right here in New York City. We're here to discuss housing prices for 2023 and how buyers are getting creative with financing options. Pierre, it's great to see you. Welcome back to Trade Talks.
Great to see you, Jill. Thanks for having me.
All right, and let's talk about the direct impact to price appreciation because of rising mortgage interest rates. What are you seeing out there?
You know, I think the whole point of the Fed increasing rates at the aggressive measure that they've taken was to predominantly temper the appreciation of housing, which is in the last 3 years. I mean, I believe housing is appreciated, roughly 20% on an annual basis, which is an unhealthy number if we were to continue that trend moving forward. So the price appreciation, we certainly have seen that become tempered significantly as a result of rates. I personally don't think pricing will decline substantially next year. Quite frankly, I'm anticipating a low to mid single digit level decline in terms of pricing because a decline is inevitable to some extent because your average monthly carrying costs on a home on your mortgage is roughly 50% higher than it was a year ago. So at some point, right, that has to impact pricing. I think it's certainly going to do the job of, hedging against further appreciation. But I think really the ultimate answer is that we still have a huge lack of supply in the housing market, and that's not being addressed. And even with everything that's taking place right now, I think due to the fact that supply is so limited, that's why I am anticipating a low single digit decline and nothing more substantial than that.
Well, I'm sure you're always getting this question, is this reminiscent of 2008, 2009? It doesn't feel like it to me.
No, and you're spot on. And I adamantly say that every time I'm asked that question. This is a completely different market, completely different cycle. And what took place was caused by factors that were nothing similar to 2008. What we had in 2008 was really, subprime lending and reckless lending standards that gave excessive mortgages, disregarded loan to value ratios, and gave mortgages to essentially anybody under the sun. And what happened was that credit was so free that it created this huge frenzy in the housing market, and people were all of a sudden developing houses left and right, and it was a very fabricated false market that was created. This is different, right? A large part of what this boom that we encountered was also due to low cost of debt, but with healthy underwriting standards and healthy issuance of credit and healthy issuance of lending practices. And it's completely night and day. Prior to 2008, what took place was absolutely reckless. I mean, subprime lending was horrific. I mean, I don't know if you were in the industry back then, but I always give the great example that when we negotiated contracts in that era, there was no such thing as a mortgage contingency because it was guaranteed you were getting a mortgage. No one even had thought 2 seconds whether you get a mortgage or not. And then all of a sudden 2008 happened, and we're negotiating transactions with clauses we haven't seen in half a decade. In that all of a sudden transactions were contingent on financing again. And luckily since then, I think that banks and real estate professionals learned a valuable lesson that's not been forgotten. And that's why I'm adamant in saying that this is nothing similar. This is nothing compared to what took place in 2000.
Yeah, it certainly doesn't feel systemic by any stretch, but there are demographics that are missing out on the housing. Who's impacting the most?
First-time home buyers. It is without question the first-time home buyer is the demographic that's going to suffer the most. Because when you think about everything going on in the world, you think about the issues now in the labor markets we're encountering. You think about mortgage payments being 50% more than they were a year ago. You think about inflation resulting in roughly $500 to $1,000 a month of additional expenses for your average American is generally the stat we see, 500 on the lower end of the range. When you take into consideration all those factors, the affluent can sustain that, right? And the affluent are what I'm seeing now in our law firm's practice in Manhattan is that the affluent are taking advantage of this as a buying opportunity. And the first-time home buyer is really the one that is being priced out of the market because pricing the increase in rates is not being compensated by the reduction in pricing, making it economically still feasible for first-time home buyers to enter. You still have somewhat relatively record high prices, just with higher carrying costs, right? So the first-time home buyer is completely axed out of the market, for the time being, and it's a really unfortunate result of everything going on. I don't think it's the intended consequence, but it's the harsh reality of it.
Yeah, well, when you think about it too, when prices come back down and there's more liquidity in the system, you have this whole concept of flipping as a business. You have private equity that's buying up, first-time home buyer type of affordability. So, I mean, it makes you wonder if there's any end in sight, because once prices come back in and rates come back down, it seems as if there's just full swoop in there to acquire these assets, which makes it even more challenging. But let me ask you about the New York City market, because that's very insular. It's its own market within the national market. Are you seeing prices come down? Are they stable? I mean, I keep hearing about record sales.
So it's funny because prices coming down is hard to tell yet, because generally speaking, these cycles take a good 6 months for the market to adjust in terms of valuations and pricing. What we are seeing, and this was my prediction months ago when I started seeing how aggressive the Fed was with rate increases, transaction volume has plummeted significantly. Right now, I think across the country that's the case. Even in Manhattan, our new transaction volume is probably down 33 to 40%. And because right now, because of the 6 month period I'm describing in terms of, the market adjusting to what's going on, there's no sense of urgency. Everybody's sitting on the sidelines. They want to see how this transpires, and why buy now if you don't have to. So we're going to have, a good probably Q3 next year where we actually see what happens. But I'm not seeing a significant decline in pricing at the moment in Manhattan.
So how are buyers taking advantage of more fancy ways to finance their home buying?
The financing, well-qualified buyers who still can take on the increase in interest rates. There's not much new going on there, to be perfectly honest. Banks are still lending loan to value. They're not too worried about, I'm not seeing any appraisal issues in the marketplace whatsoever. What we really are seeing is more cash buyers coming in, banking on the fact that rates will decline in a 2-year time period, that maybe they can use that as an opportunity to negotiate a better deal now, take advantage of what's going on in terms of a pricing perspective, and then plan on refinancing 2 years when interest rates hopefully strike what we, live with a new healthy level of, somewhere in the 4 to 5% range.
All right. Appreciate the insight as always, Pierre. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.